Hi everyone, this is Yahoo Finance, and it's basically a website that investors or equity investors use to analyze a specific share within that day because it always changes from day to day unless the market is currently closed like right now. And an example that we'll be doing will be a very popular company called Apple, and everyone knows that they sell phones and laptops and even watches. So you can either type Apple or you can use their ticker symbol AAPL, and it's the same. If you click and go through the Apple, we can see that you've got a big number here, and that big number represents the share price of a company when it closed at June 21, 4 p.m. around that time, that's in US time. And if you look at here, beside here, after hours is what the market is saying, where this is what the share price is currently trading after hours. So when the market opens, this is going to be a new price, and often this actually changes just before the market opens, maybe like an hour. They usually change dramatically sometimes. As you can see here, we've got previous close, which is currently at $209.68 USD. We know that it's in USD because it says the currency here is in USD, which is US dollars. And it's the prior day's final price of a security when the market officially closes for the day. And the next one is open, which is the price when the market opened. And that was at $210.39, which is higher than the previous close share price. But when you compare all of these numbers compared to the current share price, we can say that Apple has actually dropped down because it's at $207.49. The bid and ask. So we'll start with the bid, and it's the highest price a buyer will pay for a share. And the ask price is the opposite, which is the lowest price a seller will accept security. The day's range is the overall market day price fluctuations, and we can see that the lowest price that Apple was trading at throughout that day was at $207.11 US dollars, and the highest was $211.89 US dollars. 52-week range is self-explanatory. It's basically the years range when Apple was fluctuating between 164 to 220 US dollars throughout that year. The volume is the physical number of shares being traded, and this is not in dollar amount for a given period. Typically, we want this number to be high because if there was, say, a good news or a bad news, we want to be able to either liquidate, or should I say cash out a stock, pull it out, or you want to buy more stocks in a timely manner without having to wait for a long period of time before someone else can offer you those shares, or someone else will buy that shares from you. And usually blue chip companies like Apple, like very big companies like Apple, they tend to be trading at very high volumes, which is what makes it really safe for investors. Market cap is the total value of a company. It represents how big the company is in terms of its share price multiplied by its number of shares of outstanding, and this is how many shares available of Apple. And we know that every trading day the share price always fluctuates, so that also means that the market cap also fluctuates. Not too long ago, Apple was I believe it was the second biggest company in terms of market cap, and it was over surpassed by Nvidia, which is a semiconductor company, and Microsoft was ranked one, and I believe Nvidia surpassed both Apple and Microsoft, but Nvidia's also gone down at the last trading day, so they tend to fluctuate quite a bit on a day-to-day trading hours. Beta 5Y monthly is measures Beta 5Y monthly measures the volatility of a security or a portfolio relative to a market benchmark. And in this example, we're using Apple as the security or a share. And we're pretty much comparing it to the market benchmark. And I would say that the best benchmark that we can use for this example would be like the S&P 500, which is the top 500 companies in US, which represents the whole market because they are the ones that are performing. They are the top 500 companies that are currently performing within the US market. And it's a good benchmark because if you take the average of the S&P 500, you can pretty much do a regression analysis, and I know it sounds complicated at the moment. So the idea is that you'll run a regression that compares Apple to the market, and it will spit out a value which is either above 1, below 1, or 0. But normally you'd more often probably see a beta 5Y monthly maybe slightly above 1 or slightly below 1. And what that means is if the company has a beta 5Y monthly of, say, in this example, 1.25, it means that it's riskier than the market. Because remember, beta is volatility, and volatility can also mean risk. So in a given portfolio, you have what we call a systematic risk. So this is what happens. This is a risk that you'll always have. Even if you diversify, you can't diversify a systematic risk because it's always going to be there. Every time you invest, there's always going to be risk. And beta 5Y monthly, or we can just call it beta, is a kind of rough estimate whether or not Apple is being overreactive against the benchmark. So, but what it means is if you're willing to take in more risk, that could also mean that you will end up with more returns. So usually the higher the value with beta means the more returns that a share or a company can gain through this. Because it's measured, we can calculate it using a capital asset pricing model. But for now, just need to remember that anything above 1 is riskier than the market, and anything below 1 is less riskier than the market. The price to earnings ratio looks at how the current share price is currently trading in comparison or relative to its earnings. So the higher the share price, you could say the higher the share price, if the earnings remain constant, like it doesn't change, then that means the company will get even more expensive. So there'll be some point in time where there's so much hype about a company, or investors are really bullish, really want to own a share of that company, and that means more demand for the company, and they'll keep buying shares, and the share price go up to the point where it really doesn't justify anymore in terms of how much they're actually earning. So they're paying more in value relative to if the share price was under. So you can have a really good company that has good fundamentals, very good business economics, but it's trading at a very overvalued share price. So we like to look at it from a PE perspective, price to earnings ratio, and it's just one of a valuation metric that investors use to gauge how cheap or how expensive a share really is compared to its earnings. The earnings per share is basically how much a company is earning relative to how much shares is actually available. So the idea is the higher the earnings means that it also means that EPS is higher, and that's exactly what we want, especially when the company is releasing their earnings report usually every quarterly, and we'd like that number to go up because that means more earnings and it means more money for the investors eventually, because it tends that you'll often find that within time you'll find that what really drives the share price is the earnings, how much the company is actually able to create profit. And that's the purpose of a business, is to create profit. And if investors see a really good growth in earnings over time and it still keeps beating expectations like Wall Street expectations or market expectations, then investors will be more than willing to value the share price better. And right now it's at 644, and we can actually see a growth projection of EPS just by using Koifin, and this is just another website that I use. And it says here at 2025 projection, this is just a forecast, that it's expected that the earnings per share will grow at 7.27, which is a 10.29% increase. And that's fairly okay for a very big company like Apple. We're not really expecting Apple to grow really like big, because it's already a very big business, and big businesses tend to have a slower sustainable growth rate, unless maybe they've developed something like that would just that's just mind blowing, that would actually be like very innovative technology that investors, that would just change the way the world works or how things work.